What is unclaimed property? Unclaimed property, generally speaking, is defined as various intangible property held by businesses and owed to others, held by businesses holders, and owed to another that remains unclaimed by the owner for a certain period of time, and that period of time is called the dormancy period. We'll talk about that later, but at its core, that is what unclaimed property seeks to apply to. Unclaimed property laws also apply to tangible personal property, but those circumstances are far more limited. And so what we're really going to be talking about is intangible interests, intangible property, and that is primarily what becomes the focus of your unclaimed property audits. A couple sort of key concepts that we need to talk about relates to definitional terms that are relevant, and we'll be talking about throughout this presentation. The first of which that I'll cover is the concept of an owner. Who's an owner? It seems pretty straightforward, and it is mostly. But an owner is an individual or a person or business that is the creditor or the person that's entitled to payment of the underlying property, typically defined as someone or an entity that has a equitable or legal interest in property. The holder, typically for those folks on the phone, this is where you end up finding yourself in the context of a holder facing an audit. But a holder is the debtor or obligor. And surprisingly, or maybe not surprisingly for many folks, it's this concept of who is a holder that becomes difficult in many circumstances where you have multi-party transactions. But in essence, a holder is an entity, and these definitions vary across the states. We're going to reference at various times sort of uniform acts, and Michael referenced at the beginning the Uniform Act rewrite process. Well, forming the basis of most states' laws, unclaimed property laws, are uniform acts that were drafted back in, and we'll talk specifically about 1981 and 1995, which serve as the foundation for most state laws. States have adopted various nuances to those 81 and 95 acts, but I think as a general matter, we're referencing the 1981, 1995 Uniform Acts as serving as the basis for discussion. There are a couple states that don't adopt those uniform acts, notably Delaware and New York, two states that are particularly active in this space, do not have uniform acts, and in fact their laws are very different than the uniform acts. But generally speaking, under those acts, the definitions we're talking about here are what you'll find. Holder typically would be defined as an entity or someone in possession of property that is owed to another. And again, in the context of multi-party transactions, which we'll flesh out a little bit as we get into it, we'll talk about some litigation that's pending. You'll see that definition is a little bit hard to pin down. The other concept of an outstanding obligation that's important here is the notion of property being fixed and certain. State unclaimed property laws should not apply, and arguably do not apply, unless the holder has a fixed and certain liability to the owner of the property. What does that mean? Well, it means that unclaimed property laws do not apply to contingent or uncertain obligations. There has to be an actual debt that is owed to an individual, or unclaimed property laws do not apply. And again, it would seem simple in the context of, say, a payroll check that is issued that remains outstanding. But in many instances, and the harder issues that we deal with for our clients, the concept of fixed and certain, whether there's a contingent or actual liability owed to an individual, becomes important. And there are a number of cases that speak to this issue, including cases in California, and essentially what those cases hold is that money is not owed without a specific remedy, judgment, or acknowledgement of indebtedness. So these types of concepts are threaded through what we're going to talk about, and they're important to keep in the back of your mind. So a couple other fundamental sort of concepts that we're going to talk about. Kendall mentioned that unclaimed property laws serve a revenue function, a revenue-raising function. And so in that way, they are similar to tax laws. but unclaimed property is not a tax. And the result of that is that some of the or all of the constitutional standards, depending on how you look at it, do not apply to the assertion of jurisdiction for unclaimed property purposes. One of the core state and local tax concepts that apply to jurisdiction is nexus. In the context of state unclaimed property laws, nexus does not apply. So it does not mean, it means that if you are a holder, you do not have to have substantial nexus under the Constitution to be subject to state unclaimed property laws. Unlike in the tax context, with very few exceptions, there's generally no statute of limitations on a state's ability to assess for past liability. And the exceptions are essentially that there are, most states have some form of look-back limitation. That is, they can't audit you for years in excess of, as a very general matter, 10 years. There are certain nuances that some states have 6-year periods, others have 10 plus dormancy, I think is essentially how they have been interpreted to apply. But generally speaking, there is no hard, strict statute of limitations like you would find in the tax context. The other concept that's going to be threaded throughout, and something that Michael's going to talk about later on, is the concept of derivative rights. But at a very high level, this is a fundamental concept that permeates unclaimed property laws. And the concept is essentially that states are acting as custodians of property with respect to which there is a lost owner. And as custodian, states are stepping into the shoes of the owner and preserving the property until the owner realizes it's lost and claims it. And so what does that mean? Well, derivative rights doctrine suggests that in those contexts, the state can have no greater rights to the property than the owner. And that matters in a lot of contexts, as Michael will talk about later, and in some of the litigation, it raises the spectrum of what states ought to be able to escheat. In addition, and the final sort of key component here that contrasts with the tax law is that there's very little guidance and little clarity on administrative remedies, which means that if you're faced with an audit and you do not agree with the result, holders have a very unclear path on how to appeal that assessment or challenge that assessment. We have done extensive looking into this issue, and while there may be administrative channels to appeal those types of assessments, most states don't have a clear path, and it means that you end up oftentimes in court as opposed to sort of an administrative review process. Delaware, as an exception to that rule, in the last couple of years, they enacted a process whereby holders could avail themselves of administrative review process, but that's the exception and not the rule. I'm going to talk briefly about the types of unclaimed property. I think this is an area where most folks are going to be familiar, but the types of unclaimed property commonly subject to state unclaimed property laws: uncashed checks, AP, vendor checks, payroll, miscellaneous disbursement checks, accounts receivable credit balances, gift cards, merchandise credits, bank accounts, stock, uncashed dividend checks, unclaimed shares of stock, distributions from business associations, deposits, unidentified remittances. The reason that it's the list of property is so broad is that states have what's called a catch-all provision in their laws. Most states, again, speaking generally about Uniform Act states, and those catch-all provisions essentially state that even if the laws do not specifically enumerate property that's subject to escheat, these laws apply to all intangible interests. And so, what is not specifically defined in statute is nonetheless escheatable, either pursuant to that catch-all provision, administrative promulgations, or other informal guidance. And so those are the traditional types of property that have often been the focus of state unclaimed property laws. But this is an evolving area, and what we are finding, and this will sort of jump a little bit ahead into sort of the current audit landscape, but as the economy develops and as new property types come into focus, newer categories of property are emerging. And when we say newer, I mean, it may not be new for the folks on the phone, for all of us that live and breathe, the new economy that deal with, sophisticated financial instruments or investments that we have for ourselves and our families. But again, because these uniform acts were drafted in 1981 and 1995 respectively, the world has changed a lot in that time period, in particular as we look at moving online, different financial instruments, the different ways we interact with the, quote, Internet of Things. And so what we're finding now is state unclaimed property laws are applying to or being applied to categories of property that historically were not a focus. Now, some of these are newer than others, but generally for this purpose, we're talking about rebates, retirement accounts, brokerage accounts, other retirement benefits, gift cards, stored value cards. Those laws are currently evolving. Michael will probably mention this later. Most states have taken the position that those are exempt property, but the definition of what's a gift card for that purpose varies drastically by state. Virtual currency, daily deal vouchers, still an open question on how the laws apply to those. Rewards, loyalty points, loyalty programs more generally, miles, as well as in-game currency, in-game points, things that we do. And my most common example is Candy Crush, but there's countless other examples of games that you play online for which the state unclaimed property laws may apply. And, with the newer categories of property, we are always thinking about, potential defenses to escheatment for why these types of properties are not escheatable. And part of the discussion, the analysis relates to, whether the laws actually apply to these types of property, and given the way that the economy now works, the underlying derivative rights doctrine, the principles that apply there, and how they interact with these new types of property. And we'll talk a little bit more about that as we move through the presentation.
All right. Well, this is Kendall again. As Matt and Michael have alluded to, there are a few versions of a Uniform Unclaimed Property Act, and I would say roughly 40-something states and jurisdictions, including the territories of Puerto Rico, Virgin Islands, and Guam, all have a version of an Unclaimed Property Act. If they are not keying off of the Uniform Acts, then they have been developed independently of those. But in any event, I think we can say with confidence that every state's unclaimed property laws establish time frames, often referred to as dormancy periods, after which an obligation that has become due and payable, if not claimed or paid to an owner, will be presumed abandoned. A simple example would be a payroll check. I believe that almost every state has a 1-year dormancy period with respect to payroll checks, and that period starts running from the date of issuance, which is when the payroll obligation becomes due and payable. If it is not paid over to the employee, then at the end of the 1-year period, the obligation in that property is presumed abandoned. These laws will require holders to perform due diligence. Due diligence is in quotes. There is a statutory requirement to perform due diligence outreach and to attempt to reunite the property with the owner once it has been presumed abandoned. If that effort fails, then the states require reporting and payment, and we'll talk about which state would receive an item of unclaimed property in a few minutes. The state that receives that property is required to maintain it, to custody the property. In other words, unclaimed property laws are custodial in nature. They are not true escheat laws, which would transfer title to the property from the owner to a state. That does not happen in modern unclaimed property laws. And the states will pay the amounts over to owners if they subsequently come forward to claim the property and can prove the validity of their claim. States do have interest and penalty provisions that can apply to a holder's failure to timely report or file the property, and to other willful failures to satisfy statutory duties. And last but not least, the state laws will enumerate exemptions, and we'll just show you right now a handful of common exemptions. As mentioned a few minutes ago, gift certificates and gift cards are commonly subject to exemption from unclaimed property reporting requirements, albeit these exemptions can be conditioned on a lack of expiration dates or dormancy fees. Again, we'll cover that in more detail in a few moments. An important category of exemption, which is not as commonly found in the state laws, is a business-to-business or B2B exemption, and those exemptions apply to obligations owed by one business to another. There may be limitations placed or conditions placed on the availability of that exemption. For instance, common limitations include the need for there to be an ongoing relationship between the two business parties. And some states that do offer a B2B exemption only offer it with respect to obligations that have not been reduced to payment. And so that type of a state would distinguish between a credit that's recorded on the books of one business with regard to another business's account versus, let's say, a refund check that had been issued in payment of an acknowledged liability. Last but not least, there are a handful of states that exempt de minimis value property from reporting, but most states, with regard to what we would call de minimis property, that might be items of property valued at less than $25 or less than $50, most states will only permit a holder to report those in the aggregate, but they do nevertheless expect reporting. And so the dollar value is not typically going to be an opportunity to avoid your unclaimed property reporting obligations. Michael, you want to talk about the holder?
Yes, absolutely. And so we're going to go through in the next couple of slides some of the terms. A few of these we've already established and talked about in some detail. So I'll hit a couple of the high points and we can roll forward. So holder, as Matt explained, is basically the entity, typically a company, a business, required to report and remit unclaimed property to the state. And so in the unclaimed property industry, holder is a very common term, and in fact, the holders coalition is shorthand for the business community who's interested in unclaimed property laws and gets involved with the issues. As Matt said, there are various definitions out there. It's based usually on the Uniform Acts, but as we've talked about, there are states that deviate from the Uniform Acts. I think just to give a couple of examples, and then we can move on from this particular topic. So the issuer of a share of stock, so the publicly traded company that has stock, that's commonly the holder of the stock. A bank is the holder of a bank account. A gift card issuer, so usually the retailer, possibly a special purpose entity, whatever entity issued the gift card is who we would call the holder. And then simply, when it comes to checks, uncashed checks, AP checks, payroll checks, it's the company that wrote the check and is obligated to pay the amount if it goes uncashed. And so, as Matt said, one of the frequent debates that occurs in this space is who is the holder when there could be a scenario where there could be more than one holder. For example, rebates, you've got the retailer that sponsors the rebate program, and then the third party typically that issues the checks and processes the checks. States and unclaimed property and holders and professionals have fought over this issue for years, and it remains unclear who is actually the holder.
Hey, Michael, this is Kendall. I wanted to touch on one point with regard to holder, which is, the type of entity or the type of organization that could be a holder. And effectively, it does not matter if the entity is incorporated or is instead a partnership or a limited liability company. It also doesn't matter if the entity was formed as a for-profit enterprise or as a not-for-profit enterprise. Any entity that is holding the types of obligations or property that are outlined in the laws is effectively going to be expected to monitor compliance with these laws and to treat itself as a holder.
Yeah, great point, Kendall. So in other words, there's no general exemption applicable to not-for-profit entities.
Exactly.
Okay. Thank you. And so moving on to the concept of abandonment. Abandonment is basically the result of property remaining unclaimed for the dormancy period, which begins upon what we call a trigger. And a trigger for something like an uncashed check is simply when the check was issued or written. For other things like bank accounts and investment accounts, it's a little bit more nuanced, and the states do vary. For example, some states will consider when there was return mail to be the trigger date. And it basically just establishes it starts the ticking of the clock toward when the property must be reported. And the dormancy period is typically 3 or 5 years, as Kendall said. For payroll, it's usually shorter, like 1 year. And the trend is certainly for states to shorten dormancy periods. Originally, a lot of states had dormancy periods that were around 15 years. And now the trend is for states to go from 5 to 3, and even we've seen 2-year dormancy periods in states like Maine for things like gift cards. So certainly states are shortening these periods because of the revenue-driven nature of unclaimed property laws. Moving on to due diligence, I'll briefly address due diligence again. Kendall mentioned it earlier, and it's basically a statutory requirement to send typically first-class mail to the owner before sheeting the property, and the holders are required to comply with these due diligence processes. In our experience, holders have typically one form letter that they send per state, but I think it's important to recognize that there are states that have specific language that's required, and even formatting and typeface requirements. And I'm thinking about California. California statute spells out exactly what the heading of the letter needs to say, how big it needs to be, and sort of what other features need to be included. And so basically the due diligence letter should give the owner or the customer an opportunity to contact the holder, either to say the money isn't owed, in which case it shouldn't be escheated, or that the customer wants it back, and so the holder can get an updated address. And, of course, if the customer or owner doesn't respond, that's when the escheat requirements kick in. And so that brings us to reporting. As we've mentioned, unclaimed property is not a tax, but it has similarities in that states require annual reporting, which basically means that the holders file a report listing all of the property, line item details about the property, in order to allow the state to accept it and attempt to reunite it with the owner, which basically consists of the state uploading the information to a database and letting people search it. Majority of states, holders have to report by November 1st for property presumed abandoned as of the previous June 30th. There are several spring and summer states with earlier deadlines, such as March 1st in Delaware, and property is presumed abandoned as of the previous December 31st. So when we say like the 2016 report, for example, we typically mean the report that was filed in that year. Sometimes it could mean, if we say the 2015 report, we mean the report filed in 2016 for the year ended 2015. So those are some key terms that you hear. And then I think it's worth mentioning that a few states have an aggregation threshold so that if you have a lot of small dollar items, you don't need to list them line by line, but you can lump them into one aggregate sum and report that total. And it's typically either $25 or $50.
With that, we're going to touch on dormancy versus owner activity. As Michael was talking about, the concept of abandonment, when is property escheatable, and the answer is when it remains dormant for a certain period of time, which obviously begs the question, what does that mean, and what type of contact or activity with respect to the particular property at issue constitutes activity such that dormancy is reset or told. Historically, or if we think about the generic property types that most folks are considering, this isn't really all of that complicated of an issue. In particular, if you talk about a payroll check, well, what's dormant with respect to a payroll check that's been issued? Well, if you don't cash the check. Similarly, with a gift card, it becomes a little more, difficult or interesting. Activity with respect to a gift card is when you redeem the gift card or swipe the card, partially redeem the gift card. For AR, when a credit is applied in your account. Where this gets more interesting, in our view, is where you're talking about what is currently an area of focus for states is in the financial context, retirement account context, brokerage account context. And so the question then is, what constitutes activity with respect to a brokerage account? Again, going back to laws that were drafted many, many years ago, the state unclaimed property laws do not explicitly address that question. What's activity within a brokerage account? They speak very generally to concepts of activity, communications with the holder, sending in written communications, the cashing of a check, those sorts of things. But in the industry, the brokerage industry, the financial industry, it is not well defined what contacts one might make with respect to a brokerage account would constitute contact. For example, no state statute is clear with respect to what happens with multiple accounts. If I have 3 or 4 particular accounts with a brokerage house, what if I log in with respect to one account? What if I make a trade on that account? What if I'm receiving direct deposits? Unfortunately, state laws are not clear on this point. And what can happen in certain instances, depending on the type of enforcement, is your brokerage accounts that you're well aware of but are not interacting with on a regular basis, either because you're letting your financial advisor do it or because, frankly, it's an IRA and you let it sit. Those types of accounts are in some states subject to essentially an inactivity standard, and it raises questions about, whether your account is active, whether that's the right standard, and a whole host of other issues that are far more complicated and can be addressed probably in and of itself a 90-minute webinar. So just some of the interesting issues that we're seeing kicking around with respect to dormancy versus activity. Michael, you want to advance the slide for me? It's not clicking. Thank you. As I mentioned earlier, the concept of custodial escheat versus true escheat, just a quick word on this. Originally, unclaimed property laws in its original form were mirrored on common law escheat, where title of the property vested with the Crown. That was, if you failed to claim your property, it essentially became property of the state. Well, in this current context, custodial escheat laws, that's not what happens. Modern laws are custodial in effect, which means states are supposed to be stepping into the shoes and simply holding the property, under the assumption the owner will get it back at some point. Well, the complication there, or the nuance there, is that most states take property and hold it in their general fund and use it for operations, and allocate only a small percentage of what they escheat to paying owner claims. And it raises some interesting questions in the context of securities, where securities are liquidated. We'll talk about a case later where this comes up, but the idea that that states step into the shoes is somewhat inconsistent with situations where there's a liquidation of property and/or property then is used in the general fund. On the other hand, the secondary purpose of state unclaimed property laws is to use the funds where there's no owner for the general good, as opposed to hitting a windfall. And in that regard, the use of the property in the general fund isn't wholly inconsistent with that purpose. Jurisdictional priority rules, as Michael mentioned, I mean, we've spent a lot of time talking about what the laws apply to. We haven't spent as much time talking about where the property goes. Very briefly, the U.S. Supreme Court established the jurisdictional priority rules and reaffirmed them in subsequent decisions. But in Texas v. New Jersey, the U.S. Supreme Court set forth priority rules, which are as follows. The first priority rule states that the state of last known address of the owner of the books and records has first priority to sheet the property. If a holder does not have that address, the state of holders incorporation has a second priority to sheet the property. If the property owner's last known address is unknown or there is no record. What if neither apply? Because, say, for example, the second priority state exempts the property. Can states enforce any other rule? And we're not going to spend a lot of time on this, but a number of states, and I believe the numbers in the 30s, have enacted a so-called third priority rule or transactional priority rule, which would seek to sheet the property if the first two rules don't apply and the transaction took place in the jurisdiction. That has been the subject of litigation, and currently no court has held that rule is constitutional under the U.S. Supreme Court rules. Nevertheless, it's present in many state statutes, and it from time to time sort of crops up in one form or another.
All right, Matt, thank you. Very quickly, I'll make a comment about the public policies that underlie these laws. You've heard me reference consumer protection as being a significant focus, and in addition, there is the sort of the paired up notion that if a holder has property of another party in its possession, that the holder should not be accruing a windfall based on the owner's inattention or failure to claim his or her or its property. Therefore, this windfall policy prefers that the property be shifted into custody of the state versus maintaining the holder maintaining custody and the ability to benefit from the property. And it's important to think about the fact that when we're talking about property, we are essentially talking about dollars. It's the intangible property and the dollar value of that is, the subject of the attention by states, by holders, by the state's auditors, and by folks like us who advise holders. So, the question is, which party is better off accruing the windfall if the owner doesn't come forth? And these laws are informed by the notion that the states should be the beneficiaries of any such windfall. And why don't we just move past those to the derivative rights doctrine? Michael?
Yeah, so quickly on the derivative rights doctrine, and again, this is one of the topics we could probably spend a full 60 or 90 minutes discussing. Simply stated, derivative rights doctrine is a fundamental principle underlying all state unclaimed property laws, and it's a result of the state's custodial role in the process. It doesn't take title. It merely steps into the shoes of the owner. And so at the end of the day, the state cannot require the escheat of something of property that the quote-unquote owner is not entitled to. States have tried to circumvent or limit this doctrine, which has been recognized by numerous courts, including the Supreme Court. A couple examples of ways that states have limited it is by requiring the escheat of non-cash obligations, such as gift cards, is one example. And a couple corollary applications of the derivative rights doctrine. If somebody didn't pay money for something, the holder shouldn't be required to escheat it because we don't think there should be an enforceable debt. States tend to disagree and get aggressive on issues such as rewards points and other loyalty programs. And then finally, a few related topics that wrap up our Unclaimed Property 101 topic. The concept that there must be a fixed and certain obligation, Matt has mentioned it, so it has to be an actual liquidated debt. And then also, the state must demonstrate that all conditions precedent have been satisfied. So in other words, if somebody must be a member of a club, for example, in order to be entitled to the property in question, we would argue that the state has to show that the person was still a member at the time the property is reportable in order for it to be in fact reportable.